Hello, everybody. Thank you for joining today for our newest edition of our Investor Roundtable. Today, we are going to be highlighting the Summit Apartments, the second Summit Apartments project. It is our F Street OCLV MF3 investment. It's our next opportunity to plant another money tree and to continue growing your portfolio in real estate investments, real estate development opportunities, access to Class A multifamily buildings such as Coast. That is shown here on the screen right now. They're great investment opportunities, and we're just going to be highlighting the next one in our pipeline. So my name is Brian Gallagher. I'm an investor relations associate here at F Street, and I have here with me
Lane Guger. Sorry, I thought you were going to say my name there.
Yeah.
I'm a development associate here at F Street as well. So yeah, we'll keep moving. Thanks, Brian. So F Street OCLV MF3 LLC. It's a mouthful. Really, this is the second phase of the Summit Apartments, 58 units just north of the current MF2 development. There are a few reasons we know this is going to be successful. One, we're following success. So Coast Apartments, as Brian had mentioned, it's a 199 unit building. Currently, it's at over 190 of those 199 units leased, which is above what we would call stabilized. That happened in less than 12 months. We know there's strong demand in the housing market. There's proximity to Milwaukee, but we also draw in a different demographic here who's looking to live in a suburban area while being close to Lake Michigan, while still being able to drive 15 or 20 minutes into work into Milwaukee. We're also happy about our strong partnership with Oak Creek. We've got some great TIF incentives that we're going to be talking about later, and they've done some wonderful public improvements such as Lakeshore Commons Park right next door to our developments here.
So F Street OCLV MF3, the second phase of the Summit Apartments. It's going to be 58 units of Class A multifamily. Class A just means these are going to be great apartments. They're going to have very competitive amenities to other buildings in the area that people are paying market rates for. It's just 58 units. It should take 12 months to construct. Right now, we're planning to break ground in March or April of 2025. Also, the 58 units, it's going to be faster to lease up. So as Lane mentioned, the Coast Apartments, which were constructed last year and have now leased up, those were 199 units total. And so to reach stabilization, we had to get to about 185 to 190 units. To get to stabilization in the Summit Apartments in this phase of the 58 units, we will need to sign about 50 to 55 leases. So the faster we can build the asset and lease it up, the faster we'll be able to get to a refinance event, which is our first liquidity event of the investment. So if it takes us 12 months to construct, and we'll say conservatively 12 months to lease up, we would expect to get to the refinance within 24 months of beginning this project. And then our business plan from there after the refinance is to position ourselves for ongoing cash flows to give our investors consistent quarterly distributions where they're going to know that they have that check coming in each quarter.
Yeah, thanks, Brian. So just as a visual here, this is Summit Apartments right here. This land, right now we are constructing, we actually just broke ground this week. This is OCLV MF2. And then where you see the Summit logo here is going to be OCLV MF3. So we have the south building, the north building, they're going to complement each other. The OCLV MF2 is 74 units. MF3 is going to be 58. Slightly different unit matrix. OCLV MF2 has more of those studios and one bedrooms, whereas MF3 has more 2s and 3s. You might ask why that is, and really it just has to do with size of the lots, the construction. The projects are actually going to be close in total budget amount, and even though there's a discrepancy in units between the two, the larger units in OCLV MF3 is just going to increase that budget, but also drive higher rents. And we do believe there's a strong market here for those 2s and 3s, so we're excited about this project. As you can see here as well, we have the Coast Apartments. That's 199 units there. We have the North Ivy townhomes up here that were just constructed and finished last month. We also have some for sale townhomes along here and here. And we also have some single family homes in Lake Michigan in the background and Lakeshore Park here. If you're in the area and you haven't gotten a chance to drive through here, I'd highly recommend it. It's cool from this picture, but it's really awesome to be able to drive through. See what a great job that I think we've done and Oak Creek has done as well with this project. Awesome. We'll get into the structure of the investment here. It's very similar to what we've done in the past with our multifamily developments. We have an 8% preferred return. Until then, all cash flows go to the investors. As a quick example, say you invest $100,000, that's 1.02% of the equity in OCLV MF3. You're owed an 8% preferred return. So in year one, if you invested 100 grand, we'd owe you $8,000 for year one, so on and so forth. As we're able to procure more capital for you than the 8% preferred return, we start to use that to pay down your investment. Until your investment's fully repaid and we've paid that preferred return, we don't get to the split until then. So once we've paid you back in full, you've gotten your 8%, then it's 65% to our investors, 35% to F Street. We like to do it this way because it shows our investors that our goals are aligned with yours. We are incentivized to repay you, get your capital back to you, pay your preferred return as quickly as we can. So whether that's just free cash flows, refinance liquidity events, sale at the end of the hold period, we're doing our best to get you your capital back. Awesome. We'll move on.
So as Lane mentioned earlier, we have a very strong partnership with the city of Oak Creek. They've been, great partners with us on not just this project, but the previous projects at Lakeshore Commons, at the entire master plan community. And one of the tools they use to help us develop at this site is tax incremental financing, or TIF incentives. So the way they've structured this is it's a pay-go TIF, or a pay-as-you-go. So as we construct the building, we are increasing the value of the land that it sits on, which is in turn, it's going to increase the amount of property taxes you have to pay. And how they structure this is there's a percentage, 95% of the taxes, of the property taxes that we have to pay, are essentially waived to help boost the profitability of the investment. So this is a 19-year period where we will have property tax incentives, and we are estimating that it'll be about a $3.39 million in total incentives throughout the life of the project. And this is, a lot of municipalities use the tax incremental financing to help incentivize developers to, choose Oak Creek over, the town one over from them. But Oak Creek has been great for us, and this is, just one of their tools that they use to help our projects be successful within the city.
Awesome. We'll go over our projected returns real quick here. We're projecting on a 5-year hold period an 18.42% IRR, along with a 2.01 equity multiple. So the equity multiple is kind of the simpler way to look at it. Say a 5-year hold, if you invest $100,000, we project that we will return you $201,000. So that's over 100% return on your investment. Projected IRR of the 18.42, it's a little bit more of a confusing calculation, but really it's discounting your future cash flows back down to the present day and making it equal to zero. So it's a bit more of a financial equation heavy way to look at it. But if you'd like any help understanding that, you're more than welcome to reach out to me at lane@fstreet.com. I'd be happy to talk about it. Aside from that, we're looking at an over 10% cash on cash projection for years 3, 4, and 5 after refinance, which we're really excited about that. That's one of the best benefits of this project is we do think we can really lever up on that cash and cash after we refi. So yeah, all looks good. We do our underwriting conservatively here. We make sure not to make any assumptions that we don't think we can hit.
So not just Oak Creek is a partner for us on this project, but our construction team, Stevens, our property management team, Harmonic, and then our architecture partners, Rinka. They're all teams that we've worked with before on successful projects in the past. Stevens broke ground on MF2, which is the first phase of the Summit Apartments. They just broke ground on that earlier this month. So we're very excited about the progress that we're seeing there. Harmonic Residential, they do all of our property management for all of our multifamily developments throughout the Milwaukee area and Wisconsin as a whole. They do a great job at, communicating with us and communicating with the tenants, getting these buildings leased up with, tenants that are going to pay on time every month and, take care of the building as well. And Rinka does a great job designing these buildings. One of the things that they've done on this site is for MF3 specifically, there are lake views in several of the units that look straight through, straight through to the lake, kind of in between two of the other buildings. So at Lakeshore Commons as a whole, Rinka has done a lot to make sure that as many of the residents there as possible are going to have lake views, and that's just an added amenity which makes this development so special and so unique.
So we just have some imagery here. This is what the north phase of OCLV is going to look like of Summit. We also have a picture in the bottom right is the city improvement built by Oak Creek. So we'll move on here. So yeah, thank you all for tuning in. This is now an open forum. Please feel free to ask any questions you'd like. We'll be here for the next 5 or 10 minutes and happy to answer any questions you have. Thanks. Go ahead, Brad.
Yeah, so the question was, this is MF3, so there's MF1, MF2, and a few other investments up to date. What's coming next at Lakeshore Commons? That's a great question. So Lakeshore Commons, the development as a whole, it gets a little confusing with the amount of phases because it is such a large project that we've taken down. But if we can we flip back to the previous slide? Go to the photo of the site right here. So if you look at the screen here, so the wooded area to the left here is all future phases of Lakeshore Commons developments. There's going to be more multifamily, more single family, and duplexes and assets of that sort. So, we don't know exactly what that's going to look like right now, but there are more, there's more pieces of developable land to be developed on, and we're very excited about the future. But
there's also the potential to do some garden style in here, like we've done for Brown Deer. It's an awesome product that it offers something different than these stacked multifamily buildings do. Both are great, but this is we can actually build those at a lower basis and fit them on tighter pieces of land like you see here. Yeah, so the question was, what are the returns for years 1 and 2, and how does that compare to year 3, 4, and 5? So year 1, you're not going to see any cash flow. It's going to take us 12 months to build the building, so there's no income coming in. We have our reserves built up for this. So we have operating reserves, we have lease up reserves, and we have our interest reserves for paying our debt. So we build these high enough within our development budget to make sure we can cover all of our costs, all of our interest expense when we are going through construction, when we are leasing up. So we don't see any cash flow for that first year, and we likely won't see any cash flow until about month 20 through 24. There might be some smaller distributions before we refinance, but likely the refinance will be the first paycheck you see. It'll be a larger paycheck than just a normal quarterly distribution, because hopefully we'll be able to cash out. Our construction debt is not permanent debt. We construct the building at a certain loan, at a certain interest rate, at a value. When we refinance, we are able to take the new value of the building, because it's stabilized, because it has income, to increase our leverage on the building. And with that margin between our construction debt and our new debt, we're able to cash out our refinance, our proceeds to our investors. Now, that's a big capital event in hopefully year 2 we're looking at. After that, the cash flows will look much more ordinary, like that 10% we're projecting average years 3 through 5. And then at the end of the day, we'll have the sale. So we project that it happens in year 5 for this. It might happen in year 3. It might happen in year 10. We're going to do our best to time the market. So if somebody comes along and offers a stupidly high number that is going to benefit all the investors in year 3, we're going to take that opportunity. But if we're getting great cash flows from the building, and maybe it's not the best time to sell in year 5, maybe we hold to year 7, year 10. We're going to do whatever benefits the investors the most, because that also benefits us the most, and we want our investors to be successful. And Yeah, that's why we set up these investments like we do, so our interests are aligned on that. Yes, question relating to how the pref works, return of capital, and just want to make sure everybody knows you can see this on your investor portal as well. So there's three mechanisms that we use to pay people back on these investments. The first thing is pref. So until all of your preferred return is paid, then we start to pay down your capital. The question was regarding to the sale. So at the end of the day, when we get to the sale, most or some of your capital will likely have already been returned to you. So at that point, we take our sale proceeds, we pay all of our investors back any pref that they're owed, any capital they have outstanding, and then there is a split between the investors and F Street. Now, it's possible that all the capital is returned prior to sale, then it's just a 65% split to the investors, 35% to F Street. It's hard to say. We've underwritten it that at year 5, you will see some of the return of capital, some pref, and then our split.
But I think a good way to visualize the pref and then kind of all the distributions over and above that. So, real simple, $100,000 investor, 8% annual preferred return. If it takes us 12 months to construct and then 12 months to lease the building up, you would accrue $16,000 in preferred return. But let's say we do the refinance and we're able to return to each investor, say $30,000. You would get that $16,000 that would pay off the pref, and then anything over and above that, that $14,000 that's left would go to pay down your capital. So the pref is the first layer, but then anything over and above that, all our free cash flow is still going to our investors to reduce that principal amount that you invested in the project.
And then to add on to that, if your principal amount is paid down by $14,000, so your $100,000 investment is now $86,000, we owe you an 8% pref on your $86,000 for the next year. So that part's a little confusing. If you see it on a spreadsheet or in our investment packets, it makes it a little more simple to understand, but word of mouth is probably not the best way to, to demonstrate that. Year 2025, probably no tax benefits. Sorry, the question was regarding tax benefits. Probably none for 2025 because the building will not be operational. 2026, our cost segregation study will have tax benefits for those passive losses to offset your passive gains in your K1.
That's a great question. The question was, are we locked in on the interest rate? We're not breaking ground on this project until the spring of 2025. So right now we are not locked in on a loan product or an interest rate for this project yet. We have several conversations with lenders ongoing. And we want to maintain our flexibility and our optionality until we have to break ground. So we'll if the Fed drops rates 25 bips next month and then 25 the month after, and we were locked in at a rate today, that wouldn't be us doing our job. So right now we're still open and we're flexible, and we're going to get the lowest interest rate as possible on that construction loan. And then, if we're at either a variable rate or a fixed rate during the construction period, that is also not decided yet. And we'll have to, see where things are in January, February, March, and then we'll, execute as whatever we think is going to be best for the investors at that time.
Yeah, and it's important to note that we are not underwriting this deal thinking that interest rates are going to drop 2% come April, right? We're underwriting at today's current rates, assuming that if anything does happen, the interest rate market will probably go down. But we're not assuming that that's for sure going to happen. So we underwrite conservatively. We don't want to assume that anything's going to happen in the market because we don't have a crystal ball. But that's important to know that we are conservative in that matter. Okay, awesome. Thank you all for tuning in. That's the end of the questions. We will stick around for a couple more minutes if you have any additional ones, but feel free to reach out to me, Lane at F Street, Brian at fstreet.com. Anything else to add, Brian?
We're always available to talk to our new and existing investors. So reach out anytime. Lane and I we love talking about real estate. So it's we just like doing our job.
Yeah. All right. Thank you all.